We see listed infrastructure as poised to potentially deliver above average total returns for investors, eclipsing the traditional 8 to 10% run rate that we've seen over the course of the last 2 decades. Infrastructure is extremely well positioned today. There are a few building blocks in terms of that higher than average total return prospect. Number one, accelerating earnings growth. We'll get into some of the details and the thematics behind that as of the end of the first quarter of 2024. Number two, discounted valuations. The asset class finds itself an extremely powerful starting point to either add or initiate listed infrastructure positions. We think that these combined underpinnings have the potential and the ability for listed infrastructure to potentially prosper across different economic scenarios. One's inclusive of higher for longer interest rates, inclusive of potential or emerging market uncertainty, or number three, one of lower interest rates and broadening market support. And so we'll get into those materials here over the course of this call. If you have any questions about listed infrastructure or real assets more broadly, please reach out to me or reach out to your CBRE IM representative. So turning to our materials. And starting off here with earnings growth. Again, these are our expectations as of the end of the first quarter of 2024. And so, over the course of time, listed infrastructure has delivered roughly a 6.4% annualized rate of earnings growth. That has been the long-term average. Our expectations are for about 300 basis points higher than that. That's aided by multiple forces. It's aided by the continued pass-through of inflation. Again, infrastructure being a space which has the ability where roughly 90% of the companies pass through the higher costs of inflation to the end users of their assets. The continued support from modernizing infrastructure assets for the needs of today's economy. Number three, generative AI. We talked a little bit about this a month ago with our generative AI white paper on infrastructure, more than just a data center story. And number four, in terms of the access to capital and the balance sheet advantage that listed infrastructure finds itself in today, with very strong balance sheets, with low overall borrowing rates, with high term in their overall debt profile. Getting into some of the thematics a little bit more. Infrastructure AI, generative AI, not just a data center story. We've talked about the increased intensity, the energy intensity that generative AI efforts require compared to legacy CPUs. That in the deployment of data center assets is driving a significant upgrade to overall power demand expectations. You can see how data centers are expected to grow as a percentage of overall US electric demand. You can see what that requires and what that means from a terawatt hour perspective just over the course of the next decade. Really tremendous overall growth. Infrastructure is positioned to quite broadly meet the needs of power as an essential resource. And so we offer access not only to some of the leading regulated utilities that are quintupling their load growth expectations in light of increased power demand expectations, but we also see it in terms of clean energy developers, in terms of nuclear generation. We see an increased draw on traditional hydrocarbon assets like natural gas fired power plants. We also see a tremendous boon to some of the development portfolios of listed infrastructure's renewable wind and solar developers. We, again, have some of the most scaled entities as it relates to renewable development, coupled with very strong utility franchises across the entire globe. And so some very good positioning here in terms of how infrastructure is absolutely essential to generative AI efforts. Moving on from earnings and talking a little bit about the valuation setup for investors. So I would ask you to consider the starting point here. We've really had a year, a little bit longer than a year, in which listed infrastructure has been trading much more in line with bonds relative to broad equities. This is quite atypical compared to the historic trend over the course of the last several decades. And so what this has given rise to is an opportunity where listed infrastructure is trading at a double-digit discount relative to broad equities, compared to a high single-digit historical premium, where the multiples themselves have derated quite strongly on an absolute basis. So what are the two main building blocks for improved above average infrastructure historical returns? Well, number one, it's accelerating earnings growth, and it's accelerating earnings growth that you can buy at a very significant discount today. A little bit in terms of private market dynamics, capital market developments over the course of the first quarter. And so when we look at the private equity infrastructure market, fundraising there continues to be well supported, particularly in the rise of several mega funds that have closed over the course of the past year. These entities have a need to deploy. They have a need to deploy at scale. And there are a few places better to deploy at scale other than the listed infrastructure market. And so we're calling out renewables here. In particular, listed real assets on the renewable side have experienced some significant multiple derating since their peak in 2021. And private market participants are finding value here. And so just over the course of the first quarter alone, about $8 billion in overall transactions at very healthy premiums to listed infrastructure trading values in a space which, as I mentioned earlier, we have scaled renewable developers with very healthy development profiles, which are quite clearly, by virtue of this analysis, undervalued. And so that's just a little bit in terms of our overall materials for listed infrastructure as of the end of the first quarter of 2024. We believe the asset class is poised to generate a period of above average historical returns, eclipsing the traditional 8 to 10% level that it's provided with lower volatility over the last 2 decades. These underpinnings lead us to believe that infrastructure has the potential to prosper across different economic environments, whether ones in higher for longer rates, as it did between 2000 and 2007, where it delivered a double-digit annualized return while the 10-year Treasury traded between 4 and 5%, roughly speaking, or whether it's an emerging market distress, where the resiliency of these regulated and contracted cash flows should be prized, where the history of very healthy down capture relative to global equities should deliver reconsideration, in our view, for listed infrastructure as a key part of an overall portfolio. Or number three, in an era of potentially broadening market support. We saw in the fourth quarter alone when the recognition of a Fed pause led to a roughly double-digit uplift for listed infrastructure trading values. That's been in line with the historical track record of listed infrastructure's performance following the end of a central bank hiking cycle. So just a few things here to consider for the listed infrastructure asset class. If you have any questions on listed infrastructure, please reach out to me or the CBRE IM representative who's right for you. Thanks very much for your time and good luck with your efforts in the remainder of 2024. Thank you.